Hi, I'm Michael Regan with the Regan Team Home Loan Group, and welcome to this week's Real Estate Roundup. So, first, we're going to get to one of the biggest stories that's been going around for a few months, but really has been amplifying lately is that supposedly, according to certain sources, there are more home sellers than buyers, and it's supposedly the biggest gap on record. Yet, this is something that they haven't tracked for very long, so not really sure how valid that point is. But nonetheless, they act like this is a precursor because the market's going to fall apart, prices are going to go down because there's so many more sellers than buyers. But here's the issue that I don't understand why this is even an issue is that there are always generally more home sellers than buyers. That is why a typical balance market has 4.6 months of inventory. That means that if the current pace of sales goes, you've got about 4.6 months until you run out of houses. And that's just looking at that point in time. When we see a balanced market, that means we have almost 4.5 months of inventory, right? So you're going to have more inventory, more sellers than you will buyers, but yet that's considered a balanced market. Now, if you have less than 4.6 months inventory, then it's considered a seller's market, meaning that you can get, you typically will see overbids, multiple bids, a much hotter market and a great time to sell your house. Conversely, if you have, say, 6 to 7 months inventory, then that is a buyer's market. So you do have a lot more inventory than the market can take quickly. And so typically pricing will get softer. It doesn't mean the market's going to fall apart. It just means that, hey, there's a lot more inventory. But in reality, this is a completely normal, typical kind of thing. And if you look historically since January of 2000, you see that a typical pattern is that, well, every January you have quite a bit more sellers than buyers. Now, of course, in 2021, 22, 23, even 24, it was pretty close. And the issue with a lot of these headlines is they're just clickbait because the reality is there are usually always more sellers than buyers. So it's really not a big deal. And it is very market driven in terms of some markets, inventory will be really, really tight. And so prices are continuing to go up. Other markets will be a little softer, but that doesn't mean the housing market's going to crash. And it also doesn't mean that it's not normal for there to be more sellers than buyers. And now to the Case Shiller Home Price Index for January. And Case Shiller is the appreciation guide that's really the gold standard in the housing industry. It is delayed a few months, but nonetheless, they do track individual homes and gives us the best idea of what really home values are doing. And it showed January, we're up 0.2 month over month. And then for the year, we're showing about 0.9% appreciation across the market. And this is exactly when you want to buy. You want to buy before rates come back down because that is when appreciation happens. As soon as rates come down, you see more buyers getting to the market, overbidding, prices go up, and that's when the real appreciation happens. These conditions are great if you're buying a house because you get in before rates come down again. Because when rates come down, that's when home price appreciation really happens because you have more buyers come in the market. They pay more for the house. You have multiple offers, overbidding, and then all of a sudden you see that appreciation go up. So you want to buy when rates are a little bit elevated so that when rates come down, you get to benefit from that appreciation. And also, you can just go ahead and rewrite your mortgage and save a lot of money overall. Now to what the market's doing today. So we finished up 23 basis points in the Fannie Mae 30-year fix, and you'll see the chart. Red is bad for rates, green is good. Well, with the whole Iran war, we've seen a lot of red. Rates get a lot worse. But the nice thing is the last couple of days, we've seen rates rebound on that. And that's from a lot of things. Hopefully, obviously, the war ending at some point soon would be great news. But what also is happening is the market is realizing that as oil prices have increased significantly, that is actually, yes, it is temporarily inflationary, but it also could be a huge drag for the economy because now that people are having to pay, $100 plus to fill up their car, well, now they can't use that extra, say, $40 that they had when gas was much cheaper to buy other things. So it actually ends up being a huge drag on the economy. And if this continues, it could lead to or recessions. And so what a lot of Fed members came out this week and said that, hey, we got to be cautious because this could actually be bad for the economy in terms of not just the prices go up, but it actually could be recessionary overall because people are going to have to cut back on their spending because they're spending so much more on gas. And that's it for this week's update. Don't forget, we specialize in reverse mortgages and cash flow loans for investors and self-employed business owners. Have a great week.